Hi, and welcome back to my personal finance course. I'm Tom Mihawk. This is our chapter called Cash Management, Saving, Storing, and Making Payments. This is the second segment of two in this chapter. Remember, you can find me at tommihawk.com, my website, where you'll see what I'm doing with personal finance education and resume optimization. You can find me at LinkedIn, YouTube, my YouTube channel, where you'll find all my other chapters in the personal finance course. We talk about investments and insurance and taxes, budgets, career aspects of personal finance, where we go over resumes, stocks and bonds, and all kinds of things that you'll find interesting. And also, I just had published an ebook. An ebook. Here's my manuscript. The book is entitled Optimize Your Resume, Proven Techniques for Competitive Situations. I think you'll find it good. I hope you'll find it great. I hope you'll find it great. And I believe it has as many or more techniques to optimize your resume as any other resume book available. So let's get back. Let's wrap up this chapter. Thanks for coming back. This chapter again is called Cash Management, Saving, Storing, and Making Payments. This is the chapter where we talk about what do you do with your money? So we're talking about financial institutions. And in the last segment, we had talked about the financial services, types of accounts, and now we're talking about the financial institutions. And we want to start with deposit institutions like commercial banks, savings and loans, credit unions, mutual and cooperative banks. They're unusual, but you have them. Cooperative banks you have, for example, in Massachusetts. Um, Everyone all over the country has commercial banks. Savings and loans are meant to provide some lower fees and higher returns. Same with credit unions. You belong to a credit union when you have some affiliation. You're in a union, you're in a teachers union, maybe a religious organization. And then there are non-deposit institutions, insurance companies, investment and brokerage firms, credit card companies, finance and mortgage companies, and increasingly we have non-bank service providers. Some of them are financial technology companies or fintechs. They could be retail stores like that offer credit or stored value cards. Retail stores offer these, brand tie-in credit cards that, you're buying a suit and store says, hey, would you like a credit card? We'll give you 15% off on the suit if you take the credit card. Their hope is that you don't later, cancel the card, but rather just keep it and use it. Online banks like E-Trade and Ally Bank, online payment services like PayPal and Venmo, and peer-to-peer lending intermediaries. These are all growing greatly, and people are using them a lot. And they're providing services that historically banks have provided. So, cash account trade-offs. Rates of return are typically low. They're measured as a percentage of yield. The more compounding periods you have, the greater account growth you'll have for the same annual rate. So daily compounding is better than monthly. Monthly is better than annual. They can still tell you it's 5% per year, but if it's compounded daily, you'll have more at the end of the year than if it's compounded monthly or annually. Liquidity is the measure of the ability to receive cash from an account or from, frankly, any asset. If you want to sell your house, can you sell it in a week? Sure, I'll give you 50% for your house. But if you really want to get full value, you need longer than a week to sell your house. A car is more liquid than your home, and green, dollar bills are the most liquid, and coins, for example, because they are literally physical representation of cash. They have buying power in their physical representation. Your cash accounts, you want to be able to get cash out of them quickly or delivered to you or transferred to an account like your phone or a device like your phone so that you can make purchases quickly. Cash accounts should be designed for high liquidity, but have an inverse relationship with rates of return. I mentioned before certificates of deposit. Short-term CDs pay low interest rates. Long-term CDs, you commit to leave your money with your financial institution longer, they'll pay you a higher rate of return. Safety, account protection. You want high safety, high protection in your cash accounts. You want it in all your accounts, actually, but especially your cash accounts. Federal Deposit Insurance insures $250,000 per person per insured deposit. A married couple could get $500,000 if the account is owned jointly. So titling really matters, very important. You also can get account protection from the National Credit Union Association. Okay, so some cash account trade-offs. Restrictions, there might be many. Minimum deposit requirements, no overdraft protection, certain number of checks you can write per month. Look for fewer restrictions the better. Fees can be high and they can be numerous. You'd like to have few fees and low if you have them. You don't want to pay fees for overdraft protection, or if you could, like to not pay fees for a safety deposit box or canceled check or some other service like that. Access should be easy. They should have physical offices that are near where you want to go. Be accessible online. Be accessible by phone, right? Access is key. And consider taxes and inflation too. Inflation eats away at the value of your assets. And taxes can also, when you make a transaction, like a sale, for example. So some decisions. This is key. When interest rates are rising, you want to use long-term loans to take advantage of low current rates. So in other words, if interest rates are rising and the cost of borrowing is going up, lock in long-term rates now so that you can have low rates, and as interest rates are going up, you've locked in low. By comparison, select short-term savings instruments to take advantage of rates as they're going up. So borrow short term so that as rates go up, you continue to match it, right? Let me get in the center here, okay? So rates go up, you continue to go up. So when you're borrowing, lock in long, and as rates go up, your rates stay low. When you're lending and receiving rates of interest, go short, so that as rates go up, your savings rates go up. And conversely, if interest rates are falling, right? Use short-term loans to take advantage of lower rates when you refinance. So short-term loans so that as rates go down, you continue to refinance and lower your cost of borrowing. And select long-term savings instruments to lock in good long-term rates. If rates are falling, right? Make sure that you lock in long so as they fall, you continue to earn that high rate of return. Okay? Key to think about rates going up and down. And you learn about rates when these days, you used to have to look these things up. These days, you can find them everywhere in the news. Interest rates are going up, interest rates are going down. What's the 10-year Treasury yield? What's the 30-year Treasury yield? These things are all over the news all the time. So this chapter, I started out in segment 1 talking about how this is just the introduction to what do we do with our cash. Do we have a lot of cash? Do we not use cash? Do we use online payments? Do we use peer-to-peer lending to borrow? Do we use a financial institution like a bank? And cash management activities are changing. You used to stand in line to use a teller at a depository institution like a bank. Today you use smartphone apps on your telephone. You go into a grocery store and you hold up your phone and charge that way. And it can go right to your accounts that way, or it can be stored value. Paying with cash, writing with paper checks is what people still do, but did almost entirely in the past. Now you can pay using your smartphone, transfer money with mobile payment applications, presenting a deposit slip to the teller. I can remember when a student, it's probably 10 years ago now, but she said, I take photographs using my cell phone of a check and it deposits automatically in my account. I was blown away. I couldn't believe it. I'd never heard something like that before. Wait, you take a photo with your cell phone and it deposits automatically? Now, I know today we consider that, it's old news. It's been happening for a long time now, but 10 years ago, that was brand new. I'd never heard that. Take a photo of the check to make a deposit. To get a loan from a bank, today you might borrow from a peer-to-peer lender with an all-online application. These newer services are often offered by non-bank financial companies. Some are fintech companies. Banks and legacy financial services companies are increasingly providing these kinds of services. They want to stay up to date. Banks have fewer and fewer people walk through bank branches these days. And banks have to offer services that people are seeking, like online payments, telephone payments, telephone app borrowing, and things like that. Okay, so our last slide. So how do you choose a financial institution? And how do you choose the accounts you want to use? Well, first, reputation, high quality. Now, you might use, I'm just making this up, you might use a large bank that you know has higher fees and you know has a very high selling culture, but they offer ATMs everywhere you want to go. Maybe you travel internationally and you want to use their ATMs in foreign countries, Germany or Italy or South America. Well, that's a trade-off that's maybe worth making. However, if you want a relationship that has lower fees, higher rates of return, maybe a little bit more flexibility in lending for home mortgages, maybe you want a smaller institution. I'm not trying to pit large against small, I'm just using that as an example. So reputation and high quality matters. Ease of use. Are they available where you want to use them? Are they in physical locations where you can reach them? Do people answer the phone when you call? Do they call you back when you leave messages? Those sorts of things. Features like easy online access or many branches, such as physical access. The primary purpose. You will likely have a financial institution relationship for several financial institution relationships for their primary purpose. Maybe one for banking, one for investments, one for insurance. And there may be some overlap. You might buy some insurance at your bank. You might do some investing at your bank. You might do some cash management at your investment firm. You don't have to have them separated, but it's likely you will want to have the primary services provided by the institution that provides them. Banking, investments, insurance, as examples. Other services offered like cash accounts, investments, borrowing, fees and charges, low. You want them to be low and few. How do you find them? How do you find them? Well, first of all, if you already bank, for example, at a national bank, doesn't matter where you live. If you move from New York to Chicago, Chicago to Los Angeles, to Europe, you can still use large US banks. They may not be the most convenient in some places, but they can still be very convenient. Research online, contact the institution, ask them what their fees are. Find out how their services are set up. Ask peers if you take a new job in a new city. Ask your new colleagues, where do you bank? What's convenient? What's in the neighborhood where I'm going to live? Those sorts of things. Well, thank you for watching this second segment and the first, hopefully, in the cash management, saving, storing, and making payments chapter. I'm Tom Mihawk. You can find me at tommihawk.com, my YouTube channel, resume optimization at Instagram and Twitter, and again, my new book, Optimize Your Resume, available at Amazon. Thank you. Thanks for watching. Have a great night, and come back and see the next chapter in my personal finance series.